Welcome, everyone. In this explainer, we're going to break things down from a Wall Street perspective. We're looking at the big forces moving the market right now, everything from geopolitics to the nitty-gritty valuations of the biggest tech stocks.
All right, so here's the game plan. First, we'll tackle the huge geopolitical story that's really setting the tone. Then we're going to follow the money. I'm talking about those massive quant funds. After that, we'll zoom in on some key company fundamentals and finally put it all together into a solid strategy for what's next. So the market right now, it's on an absolute tear. We're talking about some serious extreme momentum. The S&P 500 just closed up over 3% for 3 weeks straight. Now get this. This is a super rare technical signal. It's only happened 4 times in the last 80 years. We're talking 1940, 1982, 2020, and, well, right now.
So, you gotta ask, what is fueling this historic run? Well, the main driver is a massive, and I mean violent, shift in geopolitical risk. And it's all centered around one very specific thing: the potential reopening of the Strait of Hormuz. The second Iran even hinted they might reopen the strait, the market just exploded. You saw the Russell 2000 jump 2% in a single day, and the NASDAQ 100 went on a record-breaking winning streak. And here's the key: there's no deal signed yet. This is all about investors piling in, buying the idea, the expectation that things are about to get a whole lot calmer. But here's where it gets really interesting. You've got the stock market going wild on pure optimism, right? But then you look at the betting markets, the places that trade on cold, hard odds, and they're only giving it a 43% chance of the strait reopening this month. That's a huge gap between how the market feels and what the probabilities actually suggest. And this just perfectly shows what's driving this whole rally. It's what we call a collapsing risk premium. Think of it like this. For a while, the market had a war tax baked into prices, assuming the worst-case scenario. Now, that tax is being stripped away super fast because everyone's betting on things cooling down. And you can actually see this de-risking happen in real time if you look at asset prices. The number one place to look? The oil market. At the height of all the tension, a barrel of crude for immediate delivery was trading at a crazy $40 premium over the future price. $40. That premium has now pretty much vanished. That's your clearest signal that risk is coming off the table. Okay, so that's the why behind the rally. Now, let's get into the how. What's the actual engine pushing prices up? Well, it's a mechanical force, a huge wave of buying coming from quantitative funds. We're talking about funds called CTAs, or Commodity Trading Advisors. And what they did was just a massive U-turn. They went from being $30 billion short the market, betting it would fall, to flipping completely around and going $16 billion long. That scramble to cover their short positions has been a huge, huge driver of this rally. But, and this is a big but, that engine is starting to sputter. It's running out of gas. This week, these CTA funds threw about $45 billion into the market. But the models are forecasting that next week, that number gets cut almost in half, down to maybe $23 billion. That explosive buying power from the short squeeze, it's pretty much drying up. So what does that mean for us? It's a really crucial point. With that huge, almost automatic buying pressure disappearing, the market is left way more vulnerable. We're entering what you could call a fragile window, where any bad news, especially from earnings season, which is right around the corner, could hit a lot harder and bring volatility roaring back. All right, so we've got the macro picture and we know where the money's been flowing. Let's shift gears and talk fundamentals. And honestly, there's no better place to start, no better anchor for the entire tech world than the company that makes the picks and shovels for the AI gold rush, TSMC. It's pretty simple, really. Demand for AI is just off the charts, way more than anyone expected. Because of that, the earnings forecasts for TSMC have been jacked way up, and what that does is create a really solid fundamental floor under the stock's price. And not just for TSMC, but for the whole semiconductor and AI hardware sector. So looking ahead, there are 2 huge tests for this whole AI story. First, by the end of the second quarter, we need to see if the big tech giants are still planning to spend a ton of money on this stuff in 2027. And second, by the end of the year, we need to see if they can actually make money from it. Can every dollar they pour into AI actually grow their profits? If the answer is no, then the valuations for all of big tech are going to have to be reevaluated. Big time. So you remember that CTA buying pressure we talked about? As that fades away, the spotlight swings over to the individual stocks.
The specific chart patterns for each tech giant become super important. This is what the big institutional players are watching to decide where and when they're going to put their money to work.
Let's take Tesla. The options market is basically laying out the battle lines. It's pricing in a pretty big move, but one that's statistically likely, up to about $426 a share. So that 426 level, that's the huge wall of resistance Tesla has to smash through after earnings.
Now, look at Microsoft. We just saw a textbook warning sign. The stock poked its head above 431 during the day, but it couldn't hold on. It failed to close above that critical 430 weekly trend line. For any disciplined trader, that's a yellow flag. It says, hey, hold on, don't chase this. Wait for real confirmation of a breakout.
And what about the other titans? Well, Meta is knocking on the door of a key breakout area between 690 and 730. Google, it's already broken through 1325, so there's more room to run. And Amazon looks like it's just taking a healthy breather, still on track to make new highs. Okay, that's a lot of pieces, right? Geopolitics, money flow, individual stocks. Let's pull all these threads together now and see what it means for our overall market strategy. So, the bottom line for the S&P 500. Let's assume our base case plays out. The Strait of Hormuz reopens and earnings are decent. In that scenario, we're looking at a core trading range. The ceiling, or the top end, is somewhere above 7,100. And the floor, the safety net, is down in that 6,100 to 6,200 area.
So if there's one thing to take away from all this, it's this. This whole rally got started because of good news on the geopolitical front, and it was supercharged by a huge but temporary flood of money from quant funds. Now that fuel is running low and the market has to face the ultimate reality check, earnings season. And this is the one thing you should always remember. All this short-term news and money flow can create some crazy swings, for sure. But in the long run, it's all about corporate profits. A company's actual earnings power is like gravity. It's the one force that will always pull the market back to what it's truly worth.